this is going to be a difficult 12 months in terms of how are we going to pay for everything that we've just currently spent as a government in terms of the furlough scheme, the grants, etc. And there's going to have to be changes to cover that. And there's talk about tax changes. I don't know, Neil, maybe what's your view on that? Are we going to see changes in allowances? Question for yourself.
Yeah, it's a good point, Jamie, because if we look at the backdrop, the government's borrowing more in a month than it usually does in a year. So this year, the latest forecast, although there's been quite a lot of variation in this, is 350 billion of borrowing in a single year, which outside of wartime, we've never seen anything on that scale or proportion. And we just clicked over in June that the level of government debt is now higher than the level of the UK's GDP, gross domestic product. So it's at 1.95 trillion pounds, which is quite a staggering sum, and increasing by 40 to 50 billion a month. So that's going to go up. Certainly, we've got the remainder of the furlough scheme through to October, and there will be other measures. There's the £1,000 furlough return scheme, which some companies are being good enough to just waive that, but others will certainly take it. So this level of debt is going to increase. And at the moment, the government's able to finance that. They're getting bond issues away. The Bank of England have come in and effectively underwritten that 350 billion. So they've committed more than 300 billion of intervention in the markets in terms of bond buying, which will back up that issue. So in the short term, it's manageable and it's affordable, and the interest rates are very, very low right now. So actually, the government 2 weeks ago got a bond issue away at a negative interest rate. A 5 billion issue actually went away at a negative interest rate, which is, unheard of. That you've got investors buying bonds and then paying the government for the privilege. That's not happened before. But over time, the interest rates will go up again. They'll have to roll this debt over, and there'll have to be a way of affording that. And you can't just have a one-way street where the debt keeps increasing. So I think we've got a period where there'll be a degree of caution. And we've already seen, this government's great for leaking things out, isn't it? And seeing what, then taking various opinion polls to see. We're not going to have austerity too. So we're not going to seek to chop government budgets again, as was done quite dramatically in 2009, 2010 with the coalition and onwards. We're going to steer away from austerity too. So to manage that debt in the medium to long term, the only solution must be increase in the tax burden. And we don't want to be sort of scaremongering here or anything of that nature, but inevitably you must see a drift upwards in the taxes paid by UK population. Now, how might that play out? You've had the government voted in on a manifesto which quite clearly said we won't increase income tax rates, we won't increase national insurance rates, and that was as recently as November, December last year. Seems like a long time ago now, doesn't it? But it was quite recent. And there's a lot of die-hard Tory MPs who said that's an absolute commitment. We can't be increasing income taxes, national insurance, which leads you to believe that the changes are likely to be around other areas of taxation, so capital-related tax, property-related tax, and changes in allowances and tax benefits, frankly, for clients and for consumers. So there must be and again, some of these ideas are starting to be floated now. You'll see them in the press where there's been a call to say, well, capital gains tax. Currently, you've got a fairly generous annual allowance over £12,000 where you don't pay any tax at all. A basic rate taxpayer pays 10% capital gains, and a higher rate pays 20% capital gains tax. So, these are much lower rates of tax. Now, the rationale for that, which I think is correct, is when you're saving, for example, in a general investment account, you've already been taxed. You've already paid income tax on that money that you've earned. You then save it, and then if you then sell part of that investment, you can be taxed again, but at a much lower rate. And there seems to be, to me, there's a degree of fairness to that. I think the problem you've got is that may be seen as a soft target because there aren't that many people who pay capital gains tax. So in a sense, you've seen these arguments starting to run in the press saying, well, why is that 20% for a higher rate taxpayer when the income tax is 40 to 45%? Why not just have the same tax rate? So I think capital gains tax is one that could well be under threat. I think another thing I'd say about this government, if you look at the budget they did in December last year, they looked at entrepreneurs relief, which was a great benefit for a lot of business people selling their shares. They reduced the threshold from 10 million to 1 million on that. So they've chiseled that right away. They looked at corporation tax. That was supposed to go down to 17% by this tax year, 18%, then 17%. And they said, no, we're going to leave that up at 19%. So they'd already signaled they weren't minded to follow some of these more business-related and capital-related, investment-related taxes. They were looking at them already. So I think there's a risk here that when you look at all the benefits of, some of the things we're going to talk about, which would be, the tax relief, obviously on pension contributions, particularly at a higher rate of tax, that's a great incentive to be able to save properly in their pensions. ISA allowances up to 20,000. That's again a great incentive. But all these benefits are there, and we're going to touch on them, I think, Jamie, through the course of this. I think you have to recognise there is a threat that in years to come they might be chiseled away, they might be reduced, they might be removed. So I think a good time to act now, but what the future holds, it must be the direction of travel you would expect would be negative for investors and savers. And again, as I say, I'm not being alarmist about this, but over time you could see some of these benefits being eroded.